In this video, I want to highlight 10 key characteristics of value stocks. Value stocks have several distinctive features that make them appealing to value investors looking for undervalued opportunities. And so here are some of the important traits of value stocks. Number one, low price to earning ratio, low price to earning ratio or low PE ratio. Value stocks typically have a low PE ratio compared to their industry peers, indicating that they are trading at a discount relative to their earnings. So essentially, what is low PE ratio? PE ratio means price divided by the company's earning. The company's current price divided by the company's earning. So if the quotient of that particular division, if the result is low, indicates a lower value, that means the stock is relatively cheap. So generally, value stocks have what? Have a low price to earning ratio compared to other companies, in same sector or generally in the same sector. Number two, low price to book ratio. Low price to book ratio. These stocks often have low price to book ratio, suggesting that they are undervalued based on their book value. In other words, when you divide the book value of the company, when you divide the current price all over the book value of the company, the result you get is what is called the price to book value ratio. You have a particular amount, you have a certain value which indicates, the valuation, how cheap or expensive the stock may be. And book value here simply means the net assets of the company. The net assets, the current price divided by its net assets will give you this particular ratio. And the lower, the better. If it's lower, it means the stock is relatively cheap. It's very high, it means the stock is relatively expensive in relation to other companies in the same sector. Don't forget to compare apple to apple. It should be in the same sector. Number three, stable earnings. Value stock generally exhibit stable and consistent earnings over time, reflecting a reliable business model. When it comes to value stocks, these are stocks of established companies that happen to be selling at a lower price for one reason or the other. The company might be neglected by the general market participants, and this neglect can cause the stock price to be undervalued. And so they have stable earnings. You can predict their earnings year in, year out. They have that consistent earning year in, year out. And of course, they have moats. They have competitive advantage around them. That is why you can't be rest assured that their earnings will come in, year out at an increasing value. Number four, dividends payment. Many value stocks pay dividends, offering income to investors in addition to potential capital appreciation. They pay dividend regularly, and as the stock price appreciates, you have capital appreciation as well as a regular stream of income. It's a very attractive advantage of investing in value stocks. Number five, strong financial health. Value stocks often have strong balance sheets with low level of debts as well as increased cash flow, indicating financial strength and stability. So when you have these fundamentals fully intact and these companies are selling at a lower price, they are considered undervalued. And when you buy them, certainly in a near or distant future, you are going to benefit maximally from investing in this class of stocks. Number 6, undervalued by the markets. Undervalued by the markets. These stocks are perceived as undervalued by the market, often due to temporary issues or market sentiments rather than fundamental weaknesses. Now, the issue is this: in as much as I don't doubt the efficient market theory, which stipulates that information that ought to be information about companies are readily available to invest for investors to be able to capitalize on. Yet, with this level of information being known to market participants, people still invest based on sentiments, based on emotion, not based on reason, not based on logic, not based on company fundamentals. And so this offers a kind of temporary inefficiency in the market and makes stocks, it kind of, causes stocks to be undervalued. And so as a value investor, you can now key in to buy these undervalued stocks because of the prevailing sentiment in the markets. You can buy cheap stocks that you will later benefit from in the future. Number 7, long-term potential. Long-term potential. Value stocks are usually selected based on their potential for long-term growth as the market eventually realizes their true worth. That is the expectation of a value investor. The stock can be cheap now, but eventually in the future, the market will come to realize the undervalued nature of the stocks. And once that particular value is realized, it acts as a catalyst that will compel the stock price to do what? To go high. Because the stock cannot remain cheap forever. Eventually, the market will catch up with we come to understand its undervalued nature, and then we will then key into the stock, and the stock will rise eventually. There's always that particular long-term potential. Number 8, solid business fundamentals. They typically represent companies with strong competitive advantages, reliable business models, and history of performance. History of performance. They are popular, they are strong, they are stable, they have very strong fundamentals, and they have a potential for what? For long-term capital growth, for long-term capital appreciation. So that long-term potential is inherently embedded in a typical value stocks. So please subscribe to this channel, like this video, share this video, and as well as activate on number 9 is low volatility. Low volatility. Value stocks often exhibit lower price volatility compared to growth stocks, compared to penny stocks, offering more reliability, more stability, and eliminating uncertainty in the market. So you can very easily predict the movement of value stocks because they have low volatility. They don't fluctuate as much as growth stocks or as penny stocks. So they possess low volatility. Number 10, management quality. Companies behind value stocks often have experienced, competent management team that are focused on long-term value creation. And so they are blessed with management quality. The people in the management team are the type that have a reputation for running companies effectively, efficiently, that are long-term oriented, that consider the wishes of shareholders. They treat shareholders with respect, with value, and they run the company in line with shareholders' desires.